Very good afternoon, good morning, and welcome to HYCM's workshop with myself, Giles Cochran, a Chief Currency Analyst. Very good to have you here. Just if you could let me know you can see my screen and hear my voice okay, that would be helpful. You can just use the question and answer box or the chat box. Please do use that. Hope you're doing well. Very special welcome if I met you or you came to one of the seminars in Dubai. I'm looking forward to just taking us through the session now and just explaining why markets are so spooked. And they are spooked. And just as markets are getting going, just explain that as we talk about different entries, exits, remember the whole idea of this webinar is an educational perspective. I was very pleased to receive a nice email this week, a couple of nice emails. One chap who'd found a job in trading FX options in the corporate world, and another chap who'd successfully passed his prop trading challenge. So it's really nice to see people who've been attending my webinars regularly take good progress. But the whole idea is that you can think like a trader. That's what really this is about, helping you make your own decisions, thinking like a trader. It's not about a signal service as such. Remember, when we're trading, we want to back the strength against weakness. So just like you'd expect the strong arm to beat the weaker arm, we're looking to back a strong currency against the weaker currency. And today's a really good learning example because we have a clear risk-off market. So in a risk-off market, what we expect to see is equities falling, safe haven currencies rising, high beta currencies falling, commodities typically will be falling, and government bonds will be rising. Now, we are seeing a little bit of a slight aberration from this, slightly different, but that's because I'll go over to the charts and just explain what's happening, and you'll quickly see what the issue is. The reason markets are so worried this afternoon is because of this huge spike higher in energy prices. You can see here, this is Dutch natural gas monthly futures chart, and gas has just been ripping higher. We can also see that on top of gas ripping higher, we've also had significant moves higher in the crude complex. You see the crude complex here pushing up towards 80 in WTI. And if you just take a look at this on the weekly chart, you can see that price is trying to break above that key resistance level around that 77 region. Now, that move higher in energy, natural gas, WTI crude, and also in coal prices. So you can see here coal prices is here in the orange. Really is worrying investors, and the worry is as follows. One of the biggest inputs into inflation is energy prices. So if energy prices are rising, it means inflation is likely to keep rising, and if inflation is going to keep rising, the worry for central banks is that they will have to raise interest rates more quickly than they were expecting. So if you just take a look here at the level of interest, look at bond yields, what you can see, hang on, let me just get the right chart, here we go. You can see bond yields like pushing higher this morning. The general emphasis is moving to the upside. That's moving up, not on, you know, these different economies, the German, Canadian, Australian growing, but on fears that inflation is going to get out of control and central banks are going to have to hike interest rates more quickly. And so that is a risk-off environment, and investors are worried. So we're seeing weakness in the so-called high beta currencies, weakness in the Aussie, CAD, New Zealand dollar, and strength in the safe haven currencies, the yen, the Swiss franc, and the US dollar. So we're seeing a flight to safety. Now, that's why we've seen the US dollar pushing higher. You remember, it's important to realize what moves the US dollar. And the three key things that move the US dollar have all been moving it this week. And let me just explain what that is. If you look here, Nordea Markets do a great little illustration. Now, this is called the US dollar smile theory. And it was done by a trader, I think, from Goldman, who came up with a very simple theory to understand what's moving the US dollar. And it's dead helpful. And if you just take a screenshot of this or remember it, it will help you a lot. The US dollar appreciates for two very different reasons. One, the US dollar gains if the Fed's expected to raise interest rates. So in other words, when the US is outperforming the rest of the world and there's a US economic recovery, the dollar gains. The dollar also gains when the world is worried. So just as you see strength in the yen and the Swiss franc in the world is worried, you also see strength in the dollar. So you see those two different reasons for dollar strength are very different. We've seen both this week. The US dollar has been rising, particularly over the last, sort of 10 days, on expectations that the Fed's going to taper bond purchases more quickly next year and announce a taper in November. Dollar's appreciating. Today, the dollar's appreciating as the rest of the world is worried. And so if central banks are forced to raise interest rates more quickly, it's going to mean that growth is going to be restricted. Now, what we are expecting is a US dollar reflationary trade environment. So ultimately, the rest of the globe should, medium term, should start to grow again. And as the rest of the world starts to grow again, we should have pressure on the US dollar depreciating. So can you see this week we've had all of those three key drivers in the dollar all applying at the same time? That is very challenging trading conditions. These are challenging trading conditions. And that's why these major currency pairs are being pushed and pulled. Now, if you're trading the euro-US dollar, you need to know this. The euro-US dollar is the exact opposite of the dollar index. So if you just put the dollar index and overlay it on top of the euro-US dollar, look at what you see. You see that when the dollar rises, the euro-US dollar falls. And if you put this onto a weekly chart, a daily chart, you'll see how accurate this is. Do you see how the dollar index is virtually a mirror image of the euro-US dollar? Now, if I invert the scale of the dollar index, you'll see, look, it's exactly the same. So really, whenever you're trading the euro-US dollar, you're just trading the opposite of what's happening with the dollar index. So at the moment, what we can see is that the euro-US dollar is pushing lower as the dollar is pushing higher. And those two reasons for dollar strength is what's dominating the market at the moment. That is why we're seeing these funny moves in the dollar. Now, medium term, we are expecting this reflationary trade to kick back in. So there's not a lot to be trading right now because markets are so unpredictable. But looking at any move back down to that 110 would be an excellent area to get short on the long on the dollar yen. I'll explain why. Because look here, do you see the way the dollar yen tracks the US 10-year yields? Now, US 10-year yields are moving higher on expectations that the Fed's going to taper in November and expectations that they'll be done by the middle of next year. So all of that should be supportive of the dollar against the Japanese yen. And if we just do a quick comparison here, if we look at the bond yield spread between US 10-year yields and Japanese 10-year yields, okay, and we'll just look at the bond yield spread between these two. Let's just hang on, let's here we go. Here we go. Right, now just look at these two, right? You can see here that the US 10-year minus the Japanese 10-year yields, as this bond yield spread moves higher, the dollar yen moves higher with it. Okay, so you'd expect that this bond yield spread to track very, very carefully. It does. So any retracements lower, we'd expect to find buyers. So the best area to go long dollar yen would be 110. Stocks can be placed just below that 108 region. So that's one trade that I'm looking at. I traded the breakout of that symmetrical triangle pattern, took profit at 112. Price moved lower. took another long just above 111, and then took profit with the market just pulling back earlier today on the risk off trading. Because the reason this pair is flat today is because we're seeing strength in the yen and the US dollar. So that's why we get this flat trading. Okay, but medium term, we are expecting this to move higher. So we're looking at any retracements back down to that 110. So that's a medium term trade definitely to be looking at. Let's have a look through the rest of the charts to see what we've got of anything. Gold is a lot more mixed now. There's just been a headline come out, and this headline you can see here. Russian President Putin says Russia is ready to stabilize global energy markets. Gazprom gas supplies to Europe may reach new highs. Amid these headlines, energy markets have seen downside, with UK nat gas front month future falling under GBP 300. THM with the downside also seeping into the crude complex. So in other words, Putin said, I'm going to help, right? And that upside help is what we want to see to alleviate pressure in the energy markets. So we just need to look now, and one key market to be looking at is the VIX. Now I was looking at potentially trading the VIX higher up above this trend line. So you can see this little near-term trend line just going there. If the VIX broke out, I'd look to move higher. Now the VIX is held under 25, and that's important. That means that these stocks, we wouldn't be surprised to see a little bit of a correction in stocks as a result of that. So just got to keep our eyes on what's happening with inflation, and that's going to be a key issue going forward. Now, in these kind of markets, you just got to pick your levels, pick your story, pick your narrative. Is this going to be the big correction in stocks or not? The VIX will guide our way through. The VIX keeps going under 21, then expect stocks to recover. If VIX pushes above 25, then these falls in global equities are expected to carry on. So the S&P, Dow, Nasdaq, German DAX, Euro Stocks, ASX 200, FTSE 100. All of that is good indicator of what the global indices are doing, and use the VIX as a proxy for it. We can see risk currency pairs starting to pair back a little bit. So, New Zealand dollar, Japanese yen potentially could look for a little bounce from here, moving higher. That wouldn't be unreasonable. Also looking at the pound yen, that looks quite interesting. Could look at potentially going long the pound yen. There's some pretty decent support there. We are looking potentially for that to break out high. So pound yen moving up through that sort of 151, 15, finding rejection at 151 S1 zone. There's a nice little area to potentially just limit risk here, very tight stop. And if risk does improve, then we can look at a breakout of that 152 region.
Just to once again go back to the
even potentially onto 153 and above. So quite a good risk reward scenario there in the pound yen. Yes, one last learning point that we have for today, and that is the Rbnz rate decision. Now, the Rbnz rate decision, now this is an important point to learn. Notice they raise interest rates by 0.5%. Now, normally when a central bank raises interest rates, you'd expect the currency to rise, but the currency fell today, and there's a very important reason why that happened, and it's to do with expectations. Everyone expected the Rbnz to raise interest rates. So we had what's called a buy the rumor, sell the fact response. Here you can see a buy the rumor, sell the fact response. You see, Rbnz hike rates, New Zealand dollar strength, and then it sold off rapidly. That's because if the New Zealand dollar was going to keep rising, the Rbnz would need to have been more bullish than the market was expecting. Now, what was the market expecting? They're expecting one hike, and they're expecting 4 hikes next year. So in order for the New Zealand dollar to keep going out of the meeting, then Rbnz would have to be more bullish than that. And for some time, markets have been expecting that interest rate hike. So they had the hike. And then if you just see at the end, you just see the Rbnz said the committee noted that further removal of monetary policy stimulus is expected over time, with future moves contingent on the medium-term outlook for inflation and employment. So not a very hawkish comment, just quite saying we're going to see how things go. You know, we're going to be raising interest rates, but it depends what happens in the medium-term outlook for inflation and employment. So not a very hawkish sentence. In order for the New Zealand dollar to keep going, you would have wanted to see something like, if they'd said something like, you know, we're going to be moving interest rates more quickly than we expected previously, or more slowly. That's the sort of thing that you'd need to see to move the New Zealand dollar. As it was, you just had a very classical buy the rumor, sell the fact response. Okay, so just put that down as a learning curve. And you know, with the New Zealand dollar, just so you understand how this works, I was trading the New Zealand dollar upside before my holiday at the end of August. Let me just show you. When expectations were rising for the Rbnz to hike interest rates, it was around here, like before August, and I traded that long into that 78.50 region and took profit in that region there. You see, because that was the level. Now, do we expect the Rbnz to raise interest rates more quickly than the Bank of Japan? Yes, we do, right? So that would, you could take a speculative long here, stops just below 76.23, okay? Looking for a breakout of that trend line and the retest of 79. That would be a fair enough risk reward. But remember, if the risk sentiment continues turning sour, we'd expect yen strength. And then this could keep falling lower. Any retracements at 75.50 would be great value. Now, let me just show you. The bond yield spread gives you a good indication of what's happening with a individual currency, right? So here's the New Zealand top 10-year. Take away the Japanese 10-year, okay, and that is the bond yield spread between the two of them. And when you have that bond yield spread, and I'll just get it so it's nice and easy to see, you can see here, look, to see how the price tracks the bond yield spread very closely. And now the bond yield spread is moving higher, but the price is moving lower. So, you know, actually, the balance of probabilities of the New Zealand or the Japanese yen high is going to move higher. You see, in line with that bond yield spread. So that's a pretty good entry. You can have a stop below 76 and look for a retest of 79.50. Okay, folks, so keep an eye on the energy market is the key here. That's what we need to be looking at, and that's most likely where the sort of risk sentiment is going to come from. Like, this was the move higher in UK 10-year break-even rates. So you can see the UK 10-year gilts like moved above 4%. So that's some very high inflation expectations. And natural gas futures, look how them spiking higher. So the recent move in inflation expectations has all been due to energy prices. So now with Putin sort of saying, okay, you know, going to get energy prices under control, and particularly natural gas, you know, ready to stabilize global energy markets, that's a good help. Okay. So that's the sort of thing that should bring some stability back into the markets. And we are starting to see a little bit of a pullback in natural gas prices now. So we just have a look at natural gas. We just start to see natural gas prices just pulling back a little bit. So it wouldn't be unreasonable to find sellers at that pivot point. So that's a potential sell with Putin saying that he's going to help the market. You can look to sell at market stops just above that 6.63 region. That would be reasonable. And the reason, of course, would be on President Putin's reassurance that they're ready to stabilize global energy markets. And Gazprom will make new highs in terms of what it supplies to Europe. Okay, folks, I hope that helps. If you've got any questions, please do just pop it in the question and answer box or the chat box. I am looking out for those questions now. Otherwise, it's tricky trading conditions. These are difficult trading conditions in these kinds of environments, and the best thing you can do is stick to your guns. And if you think that risk is going to return and risk sentiment will pick up, then New Zealand dollar yen, pound yen longs make sense. If you think risk is going to get worse, then looking at something like trading the VIX long makes sense as well, going long the volatility index, and short stocks, particularly short Nasdaq. And then just pick your levels, pick your stops, and try and get pushed and pulled around these kind of markets. Remember, just keep an eye on that sort of dollar smile theory. That will help you with predicting what's happening with the dollar. A very helpful little image. Dollar can move around for different reasons, and knowing what's moving the dollar when is a crucial aspect to trading it. Okay, folks, thank you all very much. Back again on Monday. We'll be looking forward to the coming week. Got US CPI and US retail sales next week, so we'll be getting ourselves ready for that. Otherwise, I hope you have a very good trading week. Take care, trade safely, and be in touch. Thanks now, everyone. Goodbye.